Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm, and I'll be your host. And today I'm joined with my good friend Phil Weiss. Hey, Phil.
Hey, Kirk, how are you doing today? Good to be here.
Doing great, doing great. Well, glad to have you here. And as we get going here, it's another crazy new week in the markets, and certainly a whole lot of nothing happened this week, and yet at the same time a lot happened. So we're gonna talk a little bit about that. So we'll talk about a few things today. I want to talk about the Fed. There was a Fed meeting, and it was interesting. I do want to talk about the framework around it. And from the Fed meeting, basically, Powell came out and said nothing's changed. And I think there was like one or two words changed in their statement, and everyone's dissecting those one or two words, trying to figure out exactly what they meant by those two word changes. And I'm thinking to myself, like, everyone's dissecting this, and the Fed's like, I could just see them at the bar, like, yeah, let's change these two words and see what they do. Like I can just see that happening, and people just don't realize. But realistically, obviously, we get very little from them, so everyone just goes through with a fine tooth comb trying to figure out what they're saying. But basically, what they said or alluded to is that there's going to be three rate drops this year, probably, or three rate cuts. Now, those of you who listen to the show frequently know that we've been prophesizing, and I'll use that word in air quotes, that we will have possibly no drops this year, maybe one. That's my guess. They're talking about three. At the beginning of the year, people were saying like 6 to 9. We were talking about maybe one, maybe two. Right now, we're talking about 0, maybe 1. I'm still zero bound. I think it's very possible that we have no rate cuts this year, and we'll get into that a little bit. But I did want to point out that the market, and here's the framework I want to leave you with before we kind of get into some other topics. It's not necessarily what the Fed said, because what the Fed said is really largely irrelevant. What matters is how the market reacts to it. And this is a little market tip. This is kind of like a hack for knowing how to invest. If you can see a piece of news come out and you could judge the reaction, that in itself is going to tell you much more than the news that came out. Here's what I mean. Now, the Fed came out and said, "Oh, we're not going to drop it more than 3 times this year. We're going to drop it 3 times." Now, some people might look at that and say, "Great, that's bullish." Some people might say, "Hey, that's bearish." It really doesn't matter what those people say, because everyone's got an opinion, right? And we know what opinions are like, or at least that's what they told me as a kid. I'm not going to use that joke on the air, but basically, everyone's got an opinion. And if you're looking at what people say, like, oh, gold's going up, gold's going down, whatever the thing is, that really doesn't matter, because the opinions sound great. What really matters is the Fed is one of those important points every periodic, like whatever, 10 times a year, or sometimes they talk more, but let's say 10 times a year, they come out and they give an opinion, right, on where they're going with the Fed funds rate. Well, what they say, unless they're going to change the rates, is really not all that important. What does matter, though, is what the market's reaction, because the market is an aggregate of millions and millions of people coming together with the right answer. Now, I say the right answer because what's really happening is it's somewhat a free market, right? And a free market is millions and millions of people coming together and making buying, selling decisions. Now, the aggregate of that will be the direction of the market. So if you have 1 million shares traded and you've got 500,000 shares selling, well, actually, you'd have 1 million shares buying and selling, right? You'd have to have that to have a transaction. But let's just say there are more buyers than sellers. Well, the price will go up. If there's more sellers than buyers, the price will go down. That's the nature of the markets. So the aggregation of all that is where the direction goes. Now, what we're trying to deduce from the Fed is the market's reaction. So if the market goes up, it means that the market sees their statement and their decision as bullish. If the market goes down, it means the market sees it as bearish. And you don't need to be a rocket scientist. You don't need to be an economist. Actually, it's probably better if you're not an economist, because it doesn't do you much good. But you don't have to be really smart. You just have to look at, is it green or is it red? Is it up or is it down? If it's up, it means that people think that this is a good thing. If it's down, it means people think it's a bad thing. So that's your hack for the day. If you know nothing else about the market, if you don't even know what a stock is, if you use that hack, you're going to get more out of this than the people who spend years getting doctor degrees in finance and in economics, because that's ultimately the truth of it. Now, long term, yeah, it may have an impact, but short term, you want to watch the direction of the market. And here's a second hack as a follow up. I'm going to hand it off to Phil. If you're watching a company get decimated, so let's say you follow this company, we'll call it Acme Rockets for the Roadrunner cartoons, right? Your Acme Rockets company, and they're getting killed, right? The Wile E. Coyote isn't buying rockets, so their earnings aren't doing very well. And so if what happens, let's say Wile E. Coyote, has some fling with a stewardess, and all of a sudden the stock gets hit and it's just down like 30% off the highs. And then let's say they come out with bad earnings and the stock doesn't drop. That is actually bullish. So what typically happens is when a stock starts to drop, they say, there's a term on the Wall Street, they say there's never just one cockroach. So if there's bad news, there's kind of this saying, there's probably more bad news in there that we haven't heard yet. So people are always a little hesitant, so that a lot of people tend to sell first and ask questions later. So what happens is, in this case, Wile E. Coyote's got some bad news coming out, and then more bad news and more bad news, and it keeps knocking the stock price down. And then earnings come out, and the stock, and it's really bad, like it's ugly. No one's buying rockets, and the stock price doesn't drop. That's actually a really bullish sign. What that means is all the bad news is out. So even if they come out and said, you know what, the Roadrunner just killed Wile E. Coyote yesterday, and the stock price rises, it's because there's no more sellers left. And when there's no more sellers left, there's only one direction to go, which is up. So that's actually a very bullish sign. And the reverse happens too. So if the stock is going up, going through the roof, we know one in particular, a semiconductor company that's probably up like, I don't know, 1,000,000% this year. You've got a company like that, and it's just going higher and higher. And let's say they come out with earnings, and they're great earnings, but yet the stock doesn't go up. That's bearish. What that means is that everyone is well ahead of the earnings report. And let's say they come out with blowout earnings and the stock goes down. What that means is the stock is overpriced. The market perceives it as overpriced based on the news that came out, because the market is basing their decisions on what they estimate will come out for earnings. But let's say it's, the stock, the earnings go up 15%, but everyone thought it'd be up 30. Well, the stock's probably going to drop because people have to discount it. So what that means in investing speak is that it's overpriced, and and it's a bearish sign, which means that you probably won't see the stock continue to go higher. So these are rules of thumb to judge the market. If you have zero investing background, experience, or knowledge, you can know more about the market than probably some of the smartest people, because some of the smartest people just look at numbers and they're frequently wrong in the short term. Long term, they could be right, but you want to watch for this, and you're going to actually get a lot out of that. I live in the great state of Massachusetts. I may be the only one who calls it that, but I digress. The great state of Massachusetts has a commercial funded by the state that says, you can't win the lottery if you don't play. For the moment, let's ignore the fact that there's a state-sponsored commercial suggesting that you go out and spend your hard-earned money gambling on lottery tickets with odds of over 100 million to 1 of winning. But it's true, you can't win if you don't play. I'm giving you the same opportunity here in the show. The only difference is I'm not asking you to buy a lottery ticket. I'm only asking 5 to 10 minutes of your time. But I will pay you at least 100 million Zim dollars for your time. We do have some foreign listeners, so if you don't like Zim dollars, we may have some other currencies as well. If you want to earn over 100 million Zim dollars, go to www.moneytreepodcast.com/free money to get your free money today. So, Phil, I know you've been around the markets for a while. What are some of your thoughts this week? What do we got going on? What do you got cooking?
One of the things that I think is interesting about the whole rate cut scenario is typically in the past, the Fed has only cut rates when we're in recession. That's usually a reaction. And here we are the Fed is saying we're going to cut rates 3 times this year. That's what the market expects. That's what the Fed is saying, and the dot plots and whatever you want to call all that stuff. But we don't know that we're in a recession. There's people keep thinking we're going to be, but we haven't seen any data to support it. So it's kind of an interesting thing to me that the Fed may be taking action to lower rates in a way that they haven't done in the past. I'm not totally sure what to make of that, but it's just very interesting to me to think about them trying to be, you could say, proactive. I'm not sure if that's the right word or not, but it's just a very unusual thing to me because that's not normally what the Fed does. They're much more reactive than they are proactive in terms of their actions. So that just leaves me with some questions. I know the market went up a lot this week until today after the Fed's announcement, because there were some that thought the Fed was going to say we're not going to cut rates 3 times this year. So the Fed just did what the market expected, and the market took that positively. That kind of ties into what you're saying, where sometimes what happens, even though some people, it's what we said was expected, but we might have been thinking less. I mean, it used to be that there were all these whisper numbers that you heard for companies' earnings all the times. The whisper numbers, like let's say the company was Acme in your case, was supposed to earn $1 a share, but the whisper number was that they were supposed to earn $1.10. If they earned $1.05, even though they beat estimates, the stock would go down because it was below the whisper number. And if they earned $1.15, yeah, the stock would go up, but maybe not as much as you thought because they only beat the whisper number by a little bit. So there's a lot of expectations that get tied into all these things. And it's really how, in the short term, it's how you perform relative to those expectations. You can see companies release earnings. Sometimes they have blowout earnings, but then the market doesn't like what they say about the next quarter or the next 6 months or whatever it may be. And the market goes down even though they had blowout earnings. So much of what we see in the market is based upon what happens relative to what your expectations are.
Yeah, I think it's really important because this is kind of like level 2 thinking when it comes to the stock market. Most people look at level 1, which is what is the price? What do I think it's going to do? Level 2 thinking is thinking beyond the actual number and looking at it from the perspective of, all right, what is stacked behind this? Remember, we talk about this in the show a lot. The market is a discounting mechanism for the future. So it's looking out 6 months and saying, what does 6 months look like? We're going to price 6 months today. So if hypothetically, let's say gold was going up to 5,000 and in 6 months, everyone thought, they'll say the Fed comes out and says, we're going to buy all the gold up to $5,000 an ounce in 6 months, right? Which is right now, it's the end of September. Okay, let's say that's the case. Well, gold is going to go up right now up to 5,000 or so. It's going to bounce around 5,000 because it's looking out 6 months. Say, well, why are we going to wait 6 months? We'll buy it today, and then it'll boost it up, right? That's an example. That's obviously not going to happen, but at least not to my knowledge. So you have to think about not just what is the price, but what is built into that price, and it's usually the future, 6 months into the future. So if you look at the price of everything, that's what it's based on. Fixed income, stock prices, all of it. So the reason we have volatility is because people are basing the future on, basing today on the future. Now, if you assume that in this example, gold's going up to 5,000 in 6 months, and once again, this is just hypothetical. Don't take this that's my recommendation. Let's say gold's going up to 5,000 in 6 months, and everyone believes it. And so gold is trading around 5,000 today because they think, well, why wait 6 months? We'll just do it right now. But then let's say the Fed comes out and says, you know what, we were wrong. It's really 4,000. Immediately, the price is going to drop to 4,000 instead of 5 because they've completely changed the game. Now people have to reprice based on that new information, which brings in volatility because now it's like, well, what's going to happen? Is it really 4? Was that a real thing? Was that a false tweet? Did somebody hack them? Like, what's going on? Like, and so you get this craziness that happens, and you get this volatility. This is what happens in stock prices. People build in a future, and then something changes, and they're like, and all the analysts are like, we got to go back to our models. Let's go reprice the model. Okay, instead of $100, now it's 98. So now the price goes down 2%, right, to accommodate that. And that's a lot of what happens in the markets. It's how the markets work. So if you're confused It's because you don't understand how people are pricing in 6 months from now. And not a lot of people do. So don't feel bad, because I don't know all the stuff that's baked in either. Nobody really does. But just know in aggregate, that's what's being built in, is 6 months from now. Now, we talked last week about some of the things we're doing well and not well. And so I always just like to kind of scroll through. We talked about cocoa, which is certainly continuing to go higher. I don't even know what to make of it. It's just, since last week, I think it took a breather for a few days and it just kept going higher. I don't know what to make of it, but I'm not an expert in cocoa, but it here's the thing that you need to be aware of. Last week we talked about this, and it's really important. It's about understanding your filter on the market compared to the actual market filter. So we had a listener chime in a few weeks ago and say, "Hey, I think you're too bearish." And I was thinking about it. I'm like, you know what? I probably am coming off bearish. Now, I try to be neutral on the show, and I try to be contrarian on the show, not because I'm one or the other, but because I'm trying to make you think. So if I'm a permabull, I should come out and talk about the bearish argument, because it'll help you get a full picture, right? And if you are yourself a permabull, a gold bug, a crypto bug, whatever you want to call yourself, like if you're one of those people, you should always be looking at the contrarian side. You should always look at the opposite side of the equation, because if you're not, then you're not getting the whole picture. It's like people who are Democrats or Republicans, and you're like, really deep blue Democrat and deep red Republican, and you're never going to change your mind. The best thing you can do is look at what the other side's saying. Not because you're going to be convinced, not because it's going to change your mind, right? Or that you need to hear it. It's because it helps you filter the world differently. You get to understand what other people are saying. And it could be politically, Democrats, Republicans, could be both sides are wrong, right? I don't fully agree with either one. I think there's something wrong with both of them. So I don't characterize myself as partisan. Now, many people do, and that's okay. But even if you are, you should always look at the other side and say, all right, the other side's saying this. How does this fit with my viewpoint in the world? Maybe I can learn something from them. Maybe they're crazy, but maybe there's a speck of truth in there, right? Which is important, right? You think about, we don't do it too much. We talk about like things like global warming or climate change on this podcast, not in itself, but in the construct of how to view things. So, for example, if you believe in climate change or global warming, you might want to listen to people who have a contrarian opinion, right? Just to hear what they're having to say. Maybe it's crazy, maybe it's not. On the other hand, people who don't believe it might want to listen and say, what are these people saying? Why are they saying it? And usually when I have these conversations with people about it, it's always the first step is, well, you want a dirty planet? I'm like, well, that's not really the conversation. Nobody wants a dirty planet. The conversation is about climate change, right? It's not about pollution, which is a different conversation. So sometimes when you have these conversations, you realize that you're talking past each other and not talking to each other. Which, if you're talking past each other, you're never going to. It's not even worth having a conversation, because you're never going to change anybody's mind. They're never going to change your mind. But if you can come together on the facts and you can disagree, and this is something I had a good conversation with a client earlier this week, and I really liked his perspective. And what he said was, he said, "Look, the two parties, oddly enough, are actually very similar, in that, generally speaking, we all agree on the same things. Like, we agree that there shouldn't be any pollution. We agree that, there should be a rule of law, right? There should be basic things. There should be freedom of speech, right? Everyone agrees there should be these things. But what we disagree on is how to get there, right? So we all disagree. Like, let's just say we all want to feel safe in our homes. Well, Republicans feel like, oh, we need gun rights, right? And the Democrats say, we don't need that. We just need more police. I'm kind of constructing the arguments for this example, so don't get all crazy because I mischaracterize your argument. But my point is everyone agrees there should be safety in your own home. Like, we all want to feel safe. But how we get there is different, right? One group of folks feels like we should be able to protect ourselves. Another group of folks feels like the government should protect us. And so it's the how you get there that is disagreed on, not the end result. And that's the thing that I think most people miss. They get stuck in the, well, you believe this and you believe that, instead of, well, actually, we believe in the same thing and we just disagree how to get there. And so if you think about the markets in the same framework, and I like using politics as a framework, not as like an end result. But you think about the markets in the same way, right? You have bulls and you have bears, right? You have people who are permanently bullish, permanently bearish. They're just always, the bears always find a way to knock down the market. The bulls always feel like it's going to the moon, right? I'm a hodler, you know? Um, and the reality is somewhere in between, right? They're both wrong and right at the same time, right? The market's not going to go straight up and the market's not going to go down straight down or down forever. Like, it's just not the case. There's always some mix there. So when the listener characterized and said, "You're very bearish," I realized, like, actually I do sound bearish, but I'm not completely bearish. In many ways, I've been bullish this year. I've been very bullish, but I don't talk about it too much because it's really hard to talk about the bullish case without sounding like a kook, right? Because if you have a stock with a PE of 200, how do you justify a PE of 200? It's hard to. Like, I can't sit here and with a straight face and be like, "Oh yeah, it could go to 300." Like, there's a certain level of craziness that comes into play. Now, if you look at 2008, you'll notice that the PE skyrocketed. It spiked. And really all that came down to was you had a misalignment of earnings and prices all at the same time, so it made it look crazy. But it was not a real number, but it showed up as a real number. So if you're looking at the markets, and especially if you listen to the show, don't take my comments as, oh, you have to go out and buy, you have to go out and sell. I've been very bullish this year, and I've realized about a month and a half ago that I wasn't bullish enough, because I realized my thesis was somewhat incorrect. And you always have to be open to being wrong. I came out a few weeks ago and said I was wrong, right? And you have to be open to that. You have to be able to say to yourself, I'm wrong. And I do this all the time. I realize, like, oops, like, I was incorrect. The market sees it going this way. I had it being more conservative. I'm wrong. I got to get on that train. And I have to think about, why was I wrong? So we talk about in the show, always ask yourself, isn't that interesting? Or, that's not acting like I thought it would. What am I missing? So if the market's going up and everyone thinks there's going to be a recession, isn't that interesting? What am I missing? How is the market going up when every really intelligent investor thinks it's going to have a recession and we're going to go into a bear market? What's going on? Now, it could be the market's short-term incorrect, or it could be these other people are incorrect. Maybe there's a piece we're missing. So if you're sitting on the sideline and bearish because you're afraid the world's going to end, ask yourself, well, why is the market going up then? I don't have an answer for you. I'm just telling you it's something to consider in your calculus. And right now, we're having a bull market and everything. I'm going to make one more point. I'm going to hand it back to Phil. There's one thing I always look at for a marker. If you look at the S&P 500, I think this year it is up. Let's see. The S&P this year is up. You have to bear with me while I try to find. Okay, around 8.55% as of this year. Okay, that's a decent return, right? It's not as good as the Nikkei, which is up 22.72 in like 3 months, which is pretty awesome. But if you look at that, you say, all right, it's up 8.5%. Now, if I look at something like the equal weighted S&P, it is I think it's up not as much, but it's definitely up. It's maybe 5%, somewhere in that neighborhood, maybe less. But anyway, let's say it's 5%. But it's also broken out to all-time highs. Now, I use this ETF, the RSP, the equal weight S&P 500, not to invest in. I use it as a gauge. And here's how I use it. If I'm looking at the S&P 500, like it has the last few years, and it's just skyrocketing, I'll ask myself, all right, what is the equal weight doing? Well, the equal weight's going sideways. Okay, then you have to look deeper. Why is that the case? Well, the case is because the biggest 7 stocks in the S&P make up 30 some odd percent of the S&P. So the weighting of their performance is massive. And as you know, that one semiconductor company has done a lot of, it's up like, I don't know, 240% in the last 12 months or something crazy. It's some ridiculous number. Well, that's obviously had an impact. Meta also, I think, had a big bump up in the past year. So that had a big weighting on the S&P. So you have to ask yourself, well, if that's outperforming, it means the biggest stocks are probably doing the best. But if you look at the equal weight, and that's actually doing well, what it means is the rally is broad-based, and that is very bullish. So if you see a handful of stocks pulling the index up, that's not necessarily bearish, because a lot of people say, well, it should go down because that won't last forever. It's not necessarily bearish. It's just not really bullish. But when all stocks across the board, not all, but the vast majority of stocks across the board are going up, which will help the RSP go up, it's bullish. It means that the market as a whole is strong. When 3 or 4 or 5 stocks are taking it up, that's weak. It's called weak breath. And then if you have strong breath, which is more stocks, so out of 500 stocks, say 400 and 450 are going up, that's really good. And so you have to take account for the fact that, wow, everything I'm seeing is very bullish. Forget the price for a moment, but all the supporting factors that I look at, that I use as a gauge to decide whether we should increase exposure, reduce it. All the factors I'm looking at are very bullish. Does that mean the market can't crash tomorrow? No, it doesn't mean that at all. It just means the market as a whole is seemingly very strong, and you have to look at your thesis and say, what am I missing if you're bearish? And I do that all the time because I realize, like, all right, I'm wrong on this. Let's switch. Let's go the other way. Let's add positions or whatever you need to do. So that's how you should be thinking about the markets. And rather than get caught up in your political bent or your bullish or bearish bent, and I equate those because they're very seemingly people are very tied into their thesis and they very rarely change. So just use that as a way to pull yourself out of the brain fog and say, all right, what am I doing wrong? Because there's a big name, I won't name him because it's I don't need to get sued, but there's a big name guy who in 2008 till about 2014 told people to short the market all the way up. Now, I don't know if he had any clients after that. I imagine probably not, but that was a really bad idea. And and he's still, I heard him on a podcast the other day, he is still adamant that he's right, even though he's been wrong for, what is that, 16 years? He's still wrong, but he's adamant that he's right. And eventually he might be right, but right now he's not. So, which means you could lose a lot of money if you don't change your mind and you don't adapt to the markets. And I think that's the thing. Are you hell-bent on being right, or do you want to make money? So that's another framework you should also take away from this. Do you want to get rich, or do you want to be right? If you want to be right, there's plenty of ways to be right. The market's probably not the best one. But if you want to make money, it's probably better to not be tied into being correct, but rather try to figure out where you're wrong and make that correction. What are your thoughts, Phil?
This gets back to a concept that I know we talked about last week too, but it's confirmation bias. We always want to find people that agree with us, and we don't try to understand the other side. But about 6 months ago, I went to a conference. It was a financial related conference, but it's a different kind of conference. And one of the conversations that was organized for that conference was around this whole concept. You think about, go back to the political arena for a second. We have certain views that we have. This party has that view, and you brought up gun control, and that's actually the one that we used in this exercise. And instead of saying, what's your real view? We had a conversation where half the people were, and if you sat on the right side of the room, you had to take the right side of the issue. If you were on the left side of the room, you had to take the left side of the issue. And we talked about gun control. And the purpose of the exercise was to try to get us to think about what the other side is thinking. Because once you try to think about what the other side is thinking, then you can start to have conversation around it. because now you're not just talking past each other, you're talking to each other. And when we invest, it's so important to understand the bullish case and the bearish case. If you're bullish, find somebody that's bearish and understand where they're coming from. Maybe you don't agree with them, but at least understand where they're coming from. And if you're bearish, find somebody that's bullish so you can see where they're coming from, because you want to see what you might be missing. That's a really important part of investing. And you've got to look at both sides always. When you look at a stock too, when we think about, we were talking a little bit before about valuation and expectations. There's a book on investing by Michael Mauboussin and Alfred Rappaport called Expectations Investing. And the main thesis in that book revolves around the idea of, if I look at a stock and it's priced at $100 and I want to look and see what type of growth, if I model it out and do my discounted cash flow, which is kind of looking what cash flow the company generates and what it might generate in the future, how that's going to grow. Well, try to understand what kind of growth the market is pricing into that stock and see, does that make sense? If you think it's reasonable, then the stock may be priced about right. If you think it's too low, well, then the stock could be a good opportunity to buy. And if you think it's too high, well, then it's a stock not to invest in. You can short. I don't really like shorting, but I understand the merits of it. But understand what those expectations are that are being used to value that stock, because it can really help you in terms of figuring out what makes sense. You don't have to come up with your own estimate. Just look at the one that the market's making and see if it's reasonable. The same thing, always try to understand both sides of the coin. Never just look at your side, because you're always going to miss things. You're going to make a lot more mistakes if you only focus on the people that agree with you and the point of view that agrees with you, as opposed to understanding both parts. I just think that's so important. We all fall victim to it. Confirmation bias is one of the biggest behavioral biases that can get in the way of success as an investor. So you want to try to consciously take steps to keep that from causing you problems.
Yeah, I agree. And I'm going to make another point here. I think I made it last week, but I'm going to say it again because it's come up a few times this week in conversations. So I'm just going to make the point. We are not going to have a civil war in this country. Please stop wishing for it. It is not going to happen. So many people feel like, oh my God, we're on the edge of a civil war and things are going to blow up and the world's going to end. And we have this apocalypse porn that we all think that the world's going to end. And I just have to reiterate again, because it keeps coming up. You have to understand that the world always feels like it's on the precipice. It always has. If you go back decades, it's always felt that way. Prior to the wall coming down and the dissolution of the USSR, like it always felt like you were on the edge of a nuclear war. And certainly there were times where we were, but generally on a day-to-day basis, it wasn't. And right now, the media is whipping everybody into a frenzy, and they feel like, oh my God, we're going to have a civil war. The election is going to be horrible. It's not. No, think about it this way. If you back into this, and this is a good exercise for anything you're doing. If you feel yourself getting triggered and going off the deep end on some issue, take a step back, okay, and think, all right, is this practical? We're going to go into civil war. Okay, what would have to happen? Well, probably you'd have to have a lot of people wishing for it or preparing for it. Not some crazy kook in the middle of the woods, not like 1% of 1% of 1% of the population, but a civil war is like half the population, or at least, right? You have to have at least that. So if you think about it, have you ever met anybody who's either preparing for it or wants it? I've not met a single person who wants it or is preparing for it. Not a single person. And I know some out there people whose ideas are definitely, a little bit far-fetched for the mainstream, right? I'm not saying they're wrong, but just they're out of the norm. I don't know a single person who is in that boat, which means it's not going to happen. So for those of you who are afraid that's going to happen, or you're watching the news and the news saying, oh, it's a civil war, just turn off the news. If the news is literally saying that, you should not only turn off the news, you should break that button on the dial so you never watch that station again. They're poisoning your brain. Okay. And this goes for both sides, because both sides are saying this. Just turn it off. Never turn that station on again, because they're lying to you. It's not happening. And no one wants it to happen. So, if you got like 15 cuckoos running around with guns, that's not a civil war. It's not. Go read history. Go read about the civil war in this country. Go read about civil wars in other countries. That's not how it happens. Okay, it doesn't happen because some cuckoo's running around with a gun. It happens because the vast majority of the population is unhappy with usually the other half or some big segment of the society, and it's just not the case. You might disagree politically, but you're not going to go shoot your neighbor because you disagree with them politically. Most people are not going to do that, which means it's not going to happen. So we have to back away from the apocalypse porn and realize that the world hasn't ended, despite the fact that we've thought this for the last 100 years, and it still hasn't ended. And if it does, why do you care? Right? If the world ends, what does this even matter? Right? So don't worry about it. What you should be focused on is, where are the opportunities? And I'm trying to pull back from my bearish tone, so hopefully everyone appreciates that. But if you look at the opportunities, right, where are the opportunities right now? There's a ton of them. If you look at the markets, there's basically been a bull market in everything this year. In not everything, but virtually everything. If I'm pulling up if I'm pulling up the futures here and doing kind of a year-to-date kind of thing, natural gas has not done well. Platinum, palladium, wheat, soybean, corn, soybean meal, canola, 30-year bonds, and a handful of other grains. But otherwise, everything else is not only doing well, but doing really well. Stock markets around the world, you got the DAX, the NASDAQ, you got the Nikkei, you got the S&P, you got the Russell 2000, you got the Euro stock index. Like, stocks across the world are doing well. You got a lot of different commodities doing well, especially cocoa, which I'll go to again. But there's a lot of things doing really well. And if you're permanently bearish, then you're really missing a lot of this opportunity. You're missing the fact that the markets are doing well this year. And so I know it's hard because sometimes they're bullish, sometimes they're bearish, but you need to keep in mind the fact that there are a lot of markets doing well. I mean, you look at crypto, which is, probably a bad marker because that's basically gambling on steroids. But, most crypto has done really well this year. Some in particular, right? Ethereum and Bitcoin in particular, but you got some other ones as well. But, there's a lot of things happening in the market. And it's not all based in crypto. There's other things doing really well. But if you're not tuning your brain to both sides, being bullish and bearish, which I will add is extremely difficult. Some of the best people on Wall Street find this hard to do. So it's not easy, but we're here to teach you. We're not here to perfect your investing knowledge. It's really just to teach you to think differently and to realize that you have to be able to take both sides. Tons of people hate George Soros, and probably for good reason. But he's also one of the best traders of our era. He is able to take a trade that he goes all in. He like levers up. If he believes something, he levers up and goes all in. And when he realizes he's wrong, he'll close out the position and go the other way. So he can play both sides. He can play one and then play the other immediately without letting his ego get into check and realize like, oh, I'm right or I'm right. You realize quickly, nope, I was wrong. Let me get out. He bet against Trump winning in the election a few years ago, and against Hillary. He bet on Hillary, and he was wrong, and he lost over $1 billion. But he very quickly went the other way, and he realized he was wrong. So you have things like that. You just have to realize that it's really hard to do, very hard. But you have to try to train your mind to do it. Because if you can, it will make you a smarter person. It will make you more mindful of what's going on around you and less likely to get duped by fake news, we'll call it, right? Because I'm coming up with that term right here. You heard it here in the show. But anyway, but that's the point. It's like you have to realize that there's a lot of false narratives and false information out there. And if you attune your mind to the fact that there's a lot of different viewpoints, it's much easier to spot. If you're really tied into your thesis and you're unwilling to change, it's going to be really hard for you to see the fake news that aligns with your viewpoint, right? Republicans, Democrats, they always get duped by their own party because they believe in it. They believe in the cause and the theme. And perma-bulls, perma-bears, same thing. They're always bearish, even if the market's going up. They're always bearish. Or they're perma-bulls. Market's going down. Great. It's another good time to buy. But if you can't flip if you can't flip your thesis around and realize where you're wrong, you'll end up losing a lot of money over the long term. And in a market like this, and I'll say this, I said this a few weeks ago, this feels like a bubble to me. Now, I'm not saying it is, and I'm also not saying that we're close to the end of it. But when you have a bull market and everything with data that's not necessarily supporting it, it feels like a bubble. Now, I was around during the late 90s. That was a bubble. And it went a lot higher, a lot further than most people thought. Most people thought it would, dump out in 95, 96, 97. I think Jeremy Grantham came out in 97 and said, all right, we're selling all our tech positions. He was really early, really early. He he lost 40% of his assets over the next 2 years because people were just like, go pound sand, Jeremy. Like, I'm going to go put all my money in tech. And people made like 100% over the next 2 years. So, yeah, he was wrong. But inevitably, he was right years later. But it doesn't mean that you're right on the timing, right? And if you're wrong on the timing, inevitably you're wrong. But he was correct in his thesis. He was just early. And oddly enough, he's very oddly 2 years ahead of his time. Each of his calls, he's typically 2 years ahead of his calls. And so you have to wait 2 years to see it happen. But if you look at the markets now, they're going up. And if you're sitting on the sidelines, if you're afraid to jump in, then you have to find a way to make money in this period that also makes you comfortable. And if you can't do that, then you should, talk to somebody who can do that. But it's certainly a challenge in this market. We are in challenging markets, and they're going to continue to be challenging. We'll have more volatility. My prediction is I think we'll have probably less volatility than most people think around the election. But, given what's going on in this country, who knows what's going on in the election? It's a crazy prediction, but I think the volatility will be less than most people think. What do you think, Phil?
I think that the reactions that we have to the news can often be so off. Think about, we've got this market that started rising in October, and with little exceptions along the way, it's basically gone straight up. And this is when people were telling us a recession is coming, recession is coming, recession is coming. Go back further. We had the conflict between Russia and Ukraine. We have the conflicts in the Middle East. And everybody thinks those are really bad for the market. I'm not saying that they're good things, but these events happen. And you watch the financial news networks in particular, when there's bad news, that scares people. They get louder when they talk about it, and they scare you. And then you take these actions based upon that. And a lot of times what they're talking about doesn't really matter, or it doesn't have the impact, because we don't really know for sure what the impact's ever going to be. So I often have conversations with clients about, don't worry about watching those networks. Honestly, I've been on them, but I don't watch them either, because to me, they're just sensationalism. There's fear-mongering, there's everything else. So I don't want to get too wrapped up in what they have to say. I'll read news, because then to me, it takes a lot of the emotion out, because I don't hear the voice inflections and I don't hear the loudness at certain points and everything else. It's a much calmer way to pay attention to the news is to read it rather than listen to people talk about it. Because when they're talking about it, they want to grab your attention. But oftentimes they're not really contributing anything of value. I remember when I was an analyst and my wife would come home and say, so what'd the market do today? And I'd say, honestly, I have no idea, because I was working as an analyst covering stocks. So I looked at the stocks that I was covering, but I didn't look at the market, because what the market does on that day-to-day basis and the news that comes around it, in the long term, they're meaningless. Ask me what made the market go up today. I can guess, because I don't really know, other than the fact that there were more buyers than sellers. That's why the market went up. That's about the only thing that I consistently say. And on the market, when it falls, there were more sellers than buyers. But I don't really know. We can only guess as to what drives it, because there's a lot of psychology and a lot of emotion that comes into play. It's good to look for contrarian things. It's good to understand what's going on. It's dangerous. Like, I take the view that the long-term market direction is up. Doesn't mean it's going up every day, Doesn't mean it's going to go up every year, but long term, I think it's going up. So I don't want to start to try and time it, or I don't want to start to pull things out or say, I'm going to sit on the sidelines, because I don't know when that's going to turn around. When the market falls, if you have that view that it's going to go up long term, if you're adding money to the market regularly, it gives you opportunity, because you can buy more shares for the same investment. If you're putting money into your 401k every month, say that the market was at 25, whatever you were buying was $25 each, and you put $200 in, you got 8 shares. Now the market falls 20%. So now that $25 is 20. And so now you're buying 10 shares. When the market gets back to where it was, you made money because you bought while the market was falling. The other piece just gets back to even. But the part that you bought when the market was falling, you made profit on that. So you benefit because you can buy more when the market falls. If you have that long-term outlook, you're going to be better off in the long run, at least from my perspective.
Yeah. Yeah. I'm going to share, just as another perspective here, I'm going to share the screen here for the global markets this year. So for those of you who think that, let's see if I can expand this. There we go. A little easier to see. So this is the global, this doesn't include the US, by the way, but this is the global different countries' stock markets. So if you look at this, you'll see the green is good, the red is bad, right? And it's based on size, it's based on companies. But if you look here, there's a lot of green globally, right? Japan, there's a ton of green. Japan's obviously been the outperformer this year. Canada's been kind of so-so. Europe, UK, Ireland, pretty decent, right? And you know, you look at South America, it's maybe not so good. But this is what's going on globally, right? It's really important. We all live in the U.S., or at least not all of us, but some of you don't. But most people who listen to this live in the U.S., and we all get stuck in our own bubble a little bit, where you know we're looking at. I'm seeing if I can pull this up. If we look at the S&P 500, for example, this is. Let me see if I can pull this up. I'm going to share this. This is the S&P 500 this year. This is year to date. So there's a lot of outperforming stocks. And we talked about earlier how there's broad-based rally. Yeah, there's companies like Tesla and Apple and Intel and Adobe that haven't done well, and Boeing, obviously, which they're just continually punching themselves in the face. But saw some great memes in Boeing. But anyway, but you know, you've got a handful of companies that aren't doing well. I'm trying to pull them out here. But then you got some great performing companies, right? And it's not just a sector. If you look at the sectors, they're kind of all over the place. I mean, real estate's not doing great. Utilities aren't doing great, but pretty much everything else is a hodgepodge, right? Consumer defensive, some are good, some are not so good. You know, financials are mostly doing well. Tech and semiconductors are mostly doing well. Software. I mean, you know, you got all this hodgepodge here, but if you look at it, most of it's green. And that should tell you something. Now, if like 5 stocks were green and everything else was red, that's probably a bad sign. And by the way, this site is FinViz. It's great for the visual people who like to see things visually. But I would just, you know, try to get a different perspective on your investing from what you currently have. Look at different perspectives, and this is why I do things like this. I look at like, all right, what is going to cause the market to go up? Well, Phil said there's more buyers than sellers, right? Now, if you looked last year, probably starting in October, I think, until pretty much now, the markets have gone more or less straight up with not much of a rest. They had a little bit of a rest in December, early January, and pretty much otherwise the S&P just keeps going up. Doesn't make any sense, not to me, but I'm not going to argue with the S&P, and I'm not going to argue with millions of people. I'm just going to say, you know what? There's something I'm missing. I'm okay with that. As long as I can manage the risk in the position, then I'm okay with that, right? Because there will be a point in time, believe it or not, where the market doesn't go up every day. I know you're going to think I'm crazy, But someday in the future, the market might not go up at least one day. At least one, maybe two, but at least one, the market won't go up. So if that's the case, how are you going to handle that? Now, the longer the market goes up without a down period, I think we had a down week last week, so I'm saying this somewhat in jest, but some people got freaked out and they started selling. Right, crypto was down the last week. Oh my God, crypto's down. It's up like a few %, since people bought in, and they're like, oh my God, I was down 7%. What do we do? Like, I don't know. What do you want to do? You want to get out? I mean, okay, get out. I wouldn't, but that's okay. Like, it's the nature of the position. The stock goes up 7% one day and nobody complains. The stock goes down 7%. Everyone's ready to jump out their first floor window. I mean, it's one of the challenges of investing, obviously, is the emotion, is that people get tied to their investments. And when things are going well, they feel great. And when things aren't doing well, they feel terrible. And if you're on that roller coaster ride where you're thinking, hey, this is great, I love it, today's a beautiful day, another beautiful day, market's up, you're in for a rude awakening at some point. Because when the market goes down, you're going to be like, oh crap, I can't take this. And at that point, it's probably just a speed bump. It's not really a landmine. It's probably just that was scary. Went down 1%. Okay, I gotta reset myself. Like, if that's what you're thinking, you're too tied into your investing. And you need to find a way to, now if the market's down 20-30%, you should probably feel that at some level, and feel like, all right, why am I okay with this? And if I'm not, why did I let it happen? So you always want to it's always easier to assess now when you feel good, but it's also harder because you deceive yourself, because you feel like, I can handle a dip. Sure you can, until it dips, and then you can't, and you're like, oh crap, I shouldn't have done that. So it's better. It's probably not easier. That was probably not correctly phrased. It is better to assess now. It's not easier, but it's better, because you can look at it and say, all right, what is my exit strategy? So any portfolio position you have, you should have an exit strategy in mind. You should ask yourself, at what point do I say I made a mistake? Or at what point do you say, okay, my thesis has changed, I need to get out? Now, it could be fundamental data. I mean, the company comes out with bad numbers. It could be the stock market pricing. It could be like you have a trailing stop of 5 or 10% or something like that. It could be you had a target and you hit it. Whatever it is, but you need to come up with that thesis. If you don't have the thesis per position, then you're not investing, you're gambling. And for those of you who are buy and hold, that is in the same boat, right? If you don't have a reason or rationale or a thesis or an exit strategy in mind, you're still gambling. Even if you're planning on holding it for 20 years, that's a thesis, right? That's a statement. Like, I'm going to hold it for the next 20 years regardless of what happens. Okay, that's investing, right? You still should have some risk management and an exit plan. But if that's your plan, is I don't care if it goes to zero, I'm going to hold for 20 years, at least you have a plan. Most people don't. Most people just put money in. They're like, I don't know what's going to happen. At some point, I'll take it out. I have no idea what I'm doing. That's not a plan. Just make sure you have a plan. Like, buy and hold, it's a plan as long as you have a plan. If it's just buy and forget, that's not a plan, and you'll end up getting yourself into trouble. Because the market will be down 50, 60%, and you'll say, I need to get out. This is too painful. I can't watch it go down anymore. If you're in that position, it's too late. It's just too late. So do that now. Do that work now. Phil, I guess we're at time. You want to wrap it up here for the week?
Sure. And I'll just add to that plan, it's important, and have it first. Don't wait to make it, or don't say, oh, I'll figure that out later. I'm just going to buy it today and figure it out later. Because part of this too, that makes it investing and not gambling, is understanding why you're right and why you're wrong. And if you have that plan, you can go back and look and say, okay, well, here's what I thought, and it worked out the way that I expected it. All right, that means you were right. But it might have worked out the way you expected it for different reasons. You need to know that, but it might also not have worked out. So now you understand what it is that you did wrong. So maybe next time you don't make that mistake again. So you want to think ahead. Don't wait till afterwards to put that plan in place. Beyond that, I think that there's more to investing than just making money. It's also about positioning you to live the life that you want. And for me, I work with women experiencing big life transitions because I know they can be stressful. And my job is to help empower women facing new beginnings with the financial knowledge and tools they need to make self-assured decisions. My firm's Apprise Wealth Management. You can download my free ebook, How to Flourish Through Life's Big Changes, at apprisewealth.com/ebook. And you can also sign up for my blog there. Thanks for having me on today, Kirk.
Yeah, thanks for coming on, Phil. That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, wealth manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.